Hello, Professor. This is Shivani, and the title for my this week's presentation is going to be time value money and bond valuation. We did discuss about the time value money in our this week's discussion question, and from this PPT, we are going to learn how is this time value money affecting the bond valuation. Okay, so bond valuation. Bond valuation is the fair value of a particular bond, while buying. It takes into account, the final value of a bond is derived by taking into account its par value, coupon rate, and the time to maturity. Time to maturity is when it is getting matured. In our given scenario, over here, we have bond A and bond B with 30-year and 5-year maturity respectively. So there are certain dynamics or the factors which are affecting this value of a bond. So the market dynamics are the dynamics which hints that what conditions this bond is reacting to. Particularly in our context, bond A and bond B has same coupon rate, but different maturity periods. So the effects of time maturity is that the long-term bonds are more volatile and sensitive because it is going to come into contact with many times of the interest rates and the fluctuation of the market. Thus, the long-term bonds will have more discounted future cash flow rates. Interest rates. Yes. So interest rates in bond have this inverse calculation going on. If the interest rate is high, bond price will be low. If the interest rate let's say they fall or they are low, the bond prices will rise, making the earlier issues of the bond, as in the one with high maturity, more in favor of the investor. But the one with the higher coupon rates or the early issuers that are our bond B are more valuable. The economic outlook means during the economic growth, the bond prices tend to fall as the rates rise. While in the recession time, the bond price will be more and the interest rates are going to fall. So basically, these three factors are something which an investor has to keep in mind while buying or selling any particular bond. Let's move. Yes. So now bond A and bond B. So we have been given this situation where we have to compare which bond will trade it at a higher price. So yes, the price of a bond, as we discussed, is determined by discounting the future cash flows, including the coupon rates and the par value. The longer a bond's maturity, that is the bond A, is more sensitive to its interest rate fluctuation because of its time value of money. Yes, a 30-year bond cash flows are farther into future. We are going to get this amount of, let's say I have a bond with 30-year maturity. I'm going to get this bond, the price money, after the discounted cash flow, after 30 years. So it is more heavy compared to the 5-year bond. This makes bond B with closer cash flow, as in I am going to get this money within the after the 5 years completely. So that is why it is going to be very much less coming into contact with the interest rates in the current market situation. Like within 5 years, there is not going to be any growth in the market or recession in the market. Till 5 years, the market is going to be the same at the time I have purchased it. So that is why I am not going to get a good heavy discounted cash flow under it. So that is why any investor, not any investor, certain investors, I would say, will trade higher with bond B. In short, shorter the time of maturity, that is 5 years, the higher is the bond price because future payments seem more valuable when they are closer. Impact of rising interest rates. Definitely, increase in interest rate, as I said, that if interest rates are increasing, the bond price will come down. Since the bond prices and interest rates are inversely related. Bond A, it is having a longer maturity period of 30 years. So it is more sensitive and it will come in contact with many of the interest rate changes. Thus, the price will fall sharper than bond B. Now, bond B, with only 5 years of maturity period, the price of bond B will decline, but it would not be pronounced or pronounced that it has been declined more than bond A, because it will come less in contact with the inflation, market changes, and so on. For example, let's say it has a coupon rate. Now, okay, coupon rate is the fixed return an investor is going to get periodically until the maturity date. So yes, it has a coupon rate of 5%, while the par value is $1,000, and the market interest rate increases from 5 to 7%. The price of bond A with 30-year will fall drastically because the, as I said, interest rate keeps on changing time to time. Now it has 30 years of maturity period. So till 30 years, it is going to get many it's going to see many of the this interest rate fluctuations. It might even go like under 5% or over 7%. So yes, the price is going to fall drastically. And while bond B will decrease on a lesser scale because it only has 5 years of maturity. So the interest rate might fluctuate between 5 to 7% only. Okay, now percentage price change. Okay, which bond is going to have higher percentage price change? So yes, bond A would have higher percentage price change because it has long duration of 30-year period. Now, long-term bonds, as we discussed, are more sensitive. Okay, so numerically, let's see this. Suppose the interest rate rises by 2%, from 7 to, let's say, it is going to like 9%. So the bond price might drop by 15% drastically because of the distant payments become much less valuable when compared to newer bonds with high interest rates. And yes, so as we discussed, if the interest rates are going to get high, the bond price will come down. And if the price might only drop by 3%, if the price of bond B is are dropping because its payments are coming sooner, because it only has 5 years of maturity period, are less affected by the changing in the rates of interest rates. Yes. In similar terms, longer the bond of maturity, the more it is affected by the interest rate, as we have discussed till now. Okay, now investment strategy. Let's think from an investor perspective. If economy is slowing down, let's say we are having a recession, then it is expected that central banks, like even now, if we see there are lower interest rates going on in certain areas which are where decisions are taken by government, and let's say government issued bonds only. The borrowing and investment is getting much more because interest rates are low. So as interest rates fall, bonds prices typically rises, as we said, because the coupon payments from existing bonds coming are more valuable right now. From investment strategy point of view, long-term bonds. In a slowing economy, definitely the long-term bonds are more attractive for investors. Let's say I have a house currently of $4 lakh in Indiana, and the interest rates are low, and I am supposed to pay my whole $4 lakh chunk, adding the interest rates in 30 years. So paying $2,500 or so every month right now from my pocket is much more feasible option for me. So that is why I will go for that. Yes. So in a slowing economy, long-term bonds become more attractive investment because the prices increase more when the interest rates fall. So when I plan to even sell this house, I might sell it for a much more chunk of price than what I have purchased at today. It is due to the longer duration, which makes them more sensitive to rate cuts. Investors can lock in the higher yields, that is a higher price on existing long-term bonds, knowing that new bonds will offer low interest rates as the economy slows down. Why shift to bonds? Yes, that's a good question. A lot of people, like even today, they are very much scared of bonds. But to be honest, yes, from after studying this, I believe that investing in bonds is much more safer option for me because it is offered by the government. So yes, bonds, particularly government bonds on high quality corporate bonds, are seen more safer investments compared to the stocks. Definitely, stocks has their own history of market affecting them every day. So they are more volatile, definitely. Rising prices. Since bond prices rise, interest rates are going to fall. So yes, this inverse relation of bonds and interest rate is going to definitely help the investor. And yes, you have an income stability. Sorry. because bonds continue to provide you the coupon payments periodically, as we discussed earlier, offering a steady income every time. So, to wrap up this presentation, I would say that investing in bonds and buying and selling completely depends on person to person, I believe. So, bond B trades at a higher price due to its short maturity, and bond experiences a larger price drop when the interest rates might fall. Oh, sorry, rise. So yes, during economic slowdown, recession, investing in bonds with longer maturity is a good strategic move, as bond prices will rise if the interest rates are going down. So yes, that was it for this presentation, and these are my references. I did study from the YouTube videos sent out, and yes, that's it for this week's presentation. Thank you so much.